What gives you opportunities is other people doing dumb things. Warren Buffett is an investor, non-pari, who has accomplished his status by sticking to some very basic rules for buying and holding investments in his portfolio. Now, in times of economic decline, pretty much like the current year, many investors ask themselves, what strategies does the Oracle of Omaha employ to keep his holding company, Berkshire Hathaway, on target? Warren Buffett is, at his very core, a value investor who seeks to build solid companies with positive future prospects at below fair value prices. So what he excels at is acquiring value company stocks, seeks to build solid companies with positive future prospects at below fair value prices. So what he excels at is acquiring value company stocks when their stock is on sale, but of course in combination with several more specific criteria. In May, its CEO, Warren Buffett, broke down the secret behind value investing, the strategy that has helped him amass his wealth, and he did so in just one sentence at the company's annual shareholders meeting.
The world changing doesn't, or new things coming along don't take away the opportunities. What gives you opportunities is other people doing dumb things. And
as crazy as that sounds, it's a fact and a principle that Warren Buffett has lived by his entire life as an investor. Why does something that sounds so illogical matter? Well, value investing is essentially buying underappreciated stocks or businesses when others are selling them at a discount and then holding them for a long term. And what a lot of people don't know is that this approach has led to some of Warren Buffett's biggest investments, especially when others are panicking. That's the key. Being wise and brave enough to buy when others are selling in fear. Case in point, this legendary investor bought the Bank of America during the 2008 financial crisis, and it remains to this day one of his biggest holdings. What's more, Berkshire Hathaway has averaged a 20.1% annual return since 1965, outperforming the S&P 500's average of 10.5%. This insane principle that he swears by helped Berkshire return a humongous 3.7,087,464% from 1965 through the end of last year. For context, that's a whole lot more than the S&P 500's 24,708% return at the same time. Imagine that. The guy plays smart, which is why he is who is today. Here's how he explains the logic behind his success.
stocks sell at silly prices from time to time. It doesn't take a high IQ to figure out that they're cheap, but it does take a temperament that's willing to step up.
Maddeningly simple if you ask me. But like he said, it takes a certain outlook to play the game the way it should be played. It is all about being brave enough to buy stocks at a lower price. And so, if you're a long-term investor, Warren Buffett believes you should actually want the stock market to go down, like on Black Friday, so you can buy stocks at a lower price. That doesn't make a whole lot of sense at first, but I'll explain. When your investments go up in value, it naturally feels great, right? You feel that you've reached a milestone. And what do you do with your stocks when the market drops? Obviously, most people's first instinct would be to sell everything, right? It's predictable, human nature, and is backed by behavioral finance studies. But here's the thing. Instinctively selling when stocks drop is often counterproductive and is a rookie mistake for long-term investors, according to Warren Buffett's standards. What he says about investors wanting the stock market to go down is in the context of an investing scenario of the US market this year after it fell almost 20% in 2022, plus very high inflation, and the recession. Well, pretty much the global recession of 2023 thrown into the mix as well.
When stocks are down, we're going to be buying on balance, and who wouldn't rather buy at a lower price at a higher price? People are really strange on that. I mean, because most of your listeners are savers, and
that means they'll be net buyers, and they should want the stock market to go down. They should want to buy at a lower price. But they have that feeling that they just feel better when stocks are going.
Warren Buffett's strategy for coping with a down market entails approaching it as an opportunity to buy good companies at reasonable prices. Now, does that make sense? If we know anything well about Warren Buffett, it's that he's a long-term player, which is why he developed an investment model that has worked for him and the Berkshire Hathaway shareholders over a long period. But behind the scenes, it's a long-term and selective strategy that incorporates a tough set of requirements before the company decides to invest. So like I said, while the rest of the market may be in a panic selling mode, Warren Buffett will instead see opportunities as prices fall to his predetermined fair valuation. Say he likes a particular stock, but it's not at the market price he wants. When it falls to his preferred value range, he's ready to buy it. What does that mean for you? When the market is down, you can buy shares of stocks at a lower and potentially earn a higher return on your investment when the market recovers. A recent example of this is how the market were during the early stages of the COVID-19 pandemic. The S&P fell about 34% from February 19, 2020 to March 23, 2020, but the stocks rebounded and made up the losses by August. And almost 3 years later, stocks are still above their pre-pandemic high, even considering the bear market of 2022. Now, do you see why, although timing the market is rarely successful, holding stock over the long term tends to be a smart strategy? So if you really think according to Warren Buffett's mindset, the market is actually there to accommodate your investing strategy, but only when the price is right. Don't forget that caveat. That's pretty much it in a nutshell. Let me know what you think of it in the comments below, and be sure to keep watching this channel to find out more advice on how to invest in stocks and trading. Bye for now.